Good morning, all. Kindly give me a thumbs up if you can hear me. Just give me a thumbs up if you can hear me loud and clear. Okay, thank you. So it's now 11 a.m. and I'm seeing based on the numbers we're having, I think we'll be able to basically proceed from here. And I'll just like to start with an introduction. My name is Alfred Mongai. I'm the training coordinator for the Piea School of Petroleum Studies. I'd like to welcome you to this webinar, which we are doing in collaboration with Stanbic Bank Kenya. And the webinar is titled Powering Wealth Beyond Paychecks. And as is the speaking to professionals within the oil and gas sector, and also individuals who are basically maybe consultants, entrepreneurs, so they can be able to understand how can they be able to build wealth beyond their paychecks. I'd like to proceed with a safety brief, and then from there we'll be able now to hand over the microphone to the team from Stanbic Bank, who I'm seeing they've already joined, and then they can be able to share the presentation and we proceed from there. So in line with the industry practice, we hope that none of you is driving, and if you are, kindly make sure come to a complete and safe stop. We also are not obstructing any traffic or pedestrians. Apart from that, we also recommend people to be aware of their environment at all times. In respect to where you're attending the meeting, kindly be aware of any emergency exit points and also an emergency assembly point where you can be able to assemble in case of an emergency. Apart from that, we also advise individuals due to the current forecast of the change in weather, kindly ensure people to be aware of their environment at all times. And also apart from that, also advise individuals to be safe mental health ambassadors at all times by ensuring that you listen twice, look twice, and speak once, be it at home or at work, so that you can be a safe mental health ambassador for your colleagues and partners and friends. With this point, we'd like to introduce the team from Stanbic Bank, who is George Getonga and also Nelson, to do an introduction of themselves and then proceed from there. Welcome, George. Welcome, Nelson.
Thank you. Thank you so much, Alfred. I'm not sure whether my camera is. Are you able to see me now?
Yes, I'm able to see you, and I'm happy to see my fellow classmate. He was my classmate at Kenyatta
Oh,
University.
wow. Awesome.
Yeah,
Thank you,
yeah.
Alfred. Yeah. The name sounded very familiar, and I'm glad I've put the name to the face, and it's good to catch up again. Thank you so much. My name is George Gitonga. I'm an investment manager at Stanbic. Support the relationship teams to enhance the returns in client portfolios. I'm really glad to be here to be able to have this conversation, powering wealth beyond paychecks. It's a very emotive, it's a very strong conversation to have, and just your availability. We're really honored to be here. So thanks a lot. I'll pass it to Nelson to introduce himself before we start.
Thank you, George, and good morning, Alfred, and to the team. It's a true pleasure to be here this morning to discuss this very important topic about powering wealth beyond our paychecks, looking ahead, planning and investing, planning our legacies going forward. So it will be a pleasure just going through the slides and interacting with the team here. Thank you, and back to you, Alfred.
Thank you. So at this point, I think I'll hand over the mics to you to basically share the presentation from your end. I think you have the right to share, so you can just proceed to share, and then we can proceed from there.
Thank you, Alfred. I believe Nelson is sharing. and we'll start. Okay.
George, confirm it's up.
Confirmed. Thank you,
All right.
Nelson.
Yes.
All right, proceed.
Yes, thank you, Nelson. Once again, the team that is here, thank you for creating time to have this conversation. Like I said, it's a conversation which is pretty straightforward in terms of the objective. The objective is to create wealth. And of course, the goal is to ensure that we are not just self-sustainable, but we also have freedom in terms of time, in terms of resources, meaning that you can do anything, you can be anywhere at any point in time because you're free. And how you become free is you build wealth. You build wealth sustainably by continually having what we call automated decisions, which are not affected by any external factors. So I'll start. We can go to the first slide, so that at least we can understand where we are coming from. We have this wealth or a framework whereby it's built on different quadrants, being creating and building. This is essentially whereby you are generating something, building your cash flows, building your resources. Then, of course, you have to live and enjoy. This is your day-to-day, your day-to-day obligations. Of course, maybe you could be having a family. Of course, you have to take them for holidays. You have to just make sure that you are living and enjoying your life. Of course, save and invest. As you build wealth, as you earn your income, you have to set aside something to save and ultimately invest to grow that money. And ultimately, you have your legacy, which you achieve by using whatever you've saved, you've invested, the resources that have grown to build a legacy. But all this has to be protected somehow for it to be sustainable. That's where your assurance is coming to ensure that your resources or your wealth is protected. And this is essentially to move from an income, which is the paycheck, to ensure that you move to a future where you're wealthy, and you become wealthy by taking what you earn, by being very consistent, protecting it, investing it, diversifying your risks, and then ultimately you'll retire with the freedom and the choice for anything that you want to do. So let's go to the next slide, Nelson. Yeah, so seated where I am right now, like maybe to share with you a brief statistics in terms of individuals that grow old without investments, and for this case, even without a pension. And in sub-Saharan Africa, it's quite troubling because you'll find that only around 19% of persons who have achieved the statutory retirement age retire with an old age pension. And the best thing or the most ideal thing to do as an individual, you're working, you're earning a paycheck, is not to look at it from a point of a one-off investment. That is a pension. No, you look at it from a point of what am I doing on a daily basis to ensure that I have a future, or I have a future that is wealthy. And how you do it is you direct the income. Whatever you get, be it your salary, be it maybe your income from any other business that you are running, is to ensure that you direct your income. Don't let other factors, external factors influence your decisions. And one thing that people keep repeating but they never do is to always pay themselves. You get your 100,000 at the end of the month, you pay your landlord, you pay KPLC, you pay Nairobi Water, you pay your debts, but you forget to pay yourself. At the end of the day, you end up investing whatever remains from all the expenditure or obligations that you have. It's very important that you automate your savings. It will help you not just ensuring that you remember, but also as for mental resilience. It will also ensure that you don't have what we call you're just shopping for the sake of it, you're just spending for the sake of it. It will ensure that you have the mental stability in terms of putting money aside on a monthly basis, on a weekly basis, depending with when you earn your income. A spending plan is also something which is very important in terms of tying it all together by making sure that whatever you get, you have a specific budget, spending budget, and ultimately whatever you invest, that is not dependent on your spending budget. Actually, your spending budget is now dependent on whatever remains after you invest. And this is how you build resilience. By building resilience is essentially, number one, having an emergency fund. Like this is a buffer for, and they say at least a 6 months expenditure buffer, managing your expensive debt, ensuring that you pay the debt that is much more with a much higher interest first, and then of course reviewing essential protection needs. And this is essentially taking maybe covers for things that are really close or dear to you. Could be a domestic package to ensure that whatever happens, in case anything happens and you need compensation, then you'll be able to lean on the protection that you've set up. Of course, the next move usually to set a target buffer and just sitting back and thinking about what do you really need in terms of cash flows, in terms of spending, in terms of debt repayment plans. So you just have a long-term view, and all this starts from a routine whereby you receive your income, you allocate, ensuring that you invest first and then spending later. Then you automate these investments, and then periodically you can do quarterly, semi-annually, or annually. You review, and then ultimately, because as you know, there is one thing called inflation, which essentially is reducing the power of the money that you have in your pocket. So every year things become more expensive, so you have to continually increase your investments or your savings to cater for the inflation. So of course you have to have, like I said from the start, there is a specific goal that you want to achieve, and for this case you have to match each goal with a horizon. There are some short-term goals, like you can say, in the next 1 year, I want to go back to school, or I want to start purchasing a house. And then, of course, there are some long-term goals that could include uh, earning even in your old age from a passive income, or even building a legacy in the future. Of course, yeah, as they say in terms of capital compounding, the more you increase the automated contributions and earlier enough, the more your money will compound. And of course, compounding is the only way that will increase your capital. It's also the only thing that will increase your wealth. You can go to the next slide, Nelson. Yeah, so in terms of when you're looking at savings and investment, you're also looking at it from a point of how are you as a person in terms of your risk profile. Your risk profile is essentially how can you handle different asset classes that you've invested in terms of volatility, in terms of liquidity, and also in terms of the duration. If you're young enough, and by young I mean if anyone below 35 years, you have quite a longer runway in terms of um, uh, which you can handle volatility, which you can handle asset classes with a higher risk. So your risk profile is slightly on the higher side. This is not the case for someone maybe who is closer to retirement or headed to retirement. Then they would need an asset which has a less risk profile in terms of liquidity, meaning that they will be able to access liquidity pretty quickly, that is not volatile in terms of the valuation, and also at the same time, the duration is not too long. And the various asset classes are one, bonds, and then we have the various fixed income products, which include the asset management products like unit trust funds. And then we have equities, which are essentially are listed companies. And then these listed companies, there's some even locally, there's some investors or some individual who even invest in equities that are listed globally. But bonds are pretty straightforward in terms of what they offer, since they offer a fixed return over a period of time, and for this case, offered by the government. Very consistent and stable in terms of return, since they are very predictable in when they pay you. Once you invest, you'll know every 6 months, this is the amount that I will receive. Some also offer early redemption in terms of amortization, meaning that even if it's a 20-year bond, the government will offer to pay you back a certain amount before maturity. Could be after 10 years, 9 years, or depending with them, the terms of that particular offer. Bonds are considered pretty low risk, since government are thought to be perpetual, and whichever government succeeds, the other has to settle obligations that were taken in the name of that sovereign entity. They are pretty straightforward to invest, since locally the Central Bank of Kenya has democratized investing in bonds. You can invest directly. You just need an app, the DAO CSD app. You can, from I think a week ago, you can even pay via M-Pesa. You can pay via your bank. So it's pretty easy to invest in these bonds. So as someone who is looking for a consistent, stable income with a low risk, bonds are some of the assets that we recommend. In terms of other fixed income products, which include the unit trust funds, those ones are offered by asset managers, and they offer different levels of risk depending with what we call the underlying assets. And by underlying assets, I mean where the fund invests. Over the past, I think 3-4 years, there has been a lot of information coming in on social media, on mainstream media, regarding unit trust funds. And those include money market funds, equity funds, special funds, all manner of funds. But these funds are not fit for everyone. Each person has their own fit because of, like I said, the risk profile. Starting from the lowest risk, which is the money market fund, going all the way with the one with the highest risk, which could include the equity funds or special funds. So it's very important to compare the risk levels of these funds before you invest, or before you are able to match these two goals. Also, some of these fixed income products are used just like an emergency fund. You'll find that a lot of fund managers these days are able to turn around. Maybe if you redeem or withdraw, they're able to turn around within 24 to 48 hours, meaning that even if you have mjengo somewhere going on, maybe going on, or in the next 3 months, you can just park your money and then we will be withdrawing. We will depend on how much you need. So very important for when you're starting. After a bank account, I think the next account you need is a money market fund account. It's the first step that now gets you into the investment environment. These asset management products, they give you access to some assets you may not even have had access individually. For instance, if you have 10,000 shillings and you want to invest in a bond, you may not be able to invest because the minimum is 50,000. But then investing that 10,000 in a money market fund, which in turn goes and invests in a bond, it gives you access to the bond without investing in it directly. And even for dollar funds, you'd find that they invest in offshore products, which you may not have access with your maybe $100, $200. But through these funds, dollar funds, you're able to access such opportunities. When you get to equities, like I said, equities are usually a long-term play in terms of duration. And the reason I say that is because you do not invest in equities just for the sake of investing. You invest because you have done your research in terms of the specific company you want to invest in. You understand their business model. You are able to see a track record of performance. You're able to see the opportunities that company has in terms of business opportunities, and you fully believe that company is in terms of the company is mature in terms of the earnings that they post, or there is a room for growth, which will be reflected in the capital gains or the movement of that share price. You may also be looking to invest because you feel that the company is fully mature and it consistently posts good results and consistently pays their shareholders what I would say competitive or attractive dividends. So it's either of the two, dividends or growth. So if you're looking for growth, the growth will be reflected in the share price, moving from maybe 10 shillings, or maybe if we take a company like Safaricom, moving from the current level of 36 shillings a share to maybe 40 shillings a share or 50 shillings a share. You are looking for growth. If you are looking for dividends, you can say here maybe these are Stanbic shares or KCB shares or Equity Bank shares. They usually give a consistent maybe 9% every year in terms of dividend. But the ultimate goal, like we stated from the start, is to match your goals with the horizon, and also to understand your liquidity preference, and at the same time your risk tolerance. Once you do that, you'll be able now to identify the solution that will work for you to achieve your goal with the three factors within that particular environment, which is the horizon. How long do you want to invest? Liquidity. How soon or how frequent do I need money in terms of cash flow? And then, of course, what kind of risk you can take. We can move to the next slide, Nelson. Yeah, so as an example, we would like to show you examples of the bonds that were recently listed or reopened. So at these three bonds that were reopened, they just closed last week. And just to understand all this, what it means, the first bond there, you see it's IFB1 2019-016. It means it was first issued in 2019 to run for 16 years, meaning that the maturity will be in 2035. A coupon is the interest element of that bond per annum. So this bond is giving 11.75% per annum. And one important thing about this infrastructure bond is that they are tax free, like the interest is not subject to any tax. So if it's 11.75%, at the end of the day, you put in your 100,000, every year you'll get 11,750, no deduction at all. Then there's something we call the yield to maturity. I don't want to be very technical with that, but this usually communicates the return, the real return, if you invested in this bond, held it to maturity, and reinvested all interest or all coupon at the same rate. It will give you a return of 12.19. So the higher the yield, the better for you. And the higher the yield, the lower the price you pay for that particular bond. It closed last week, and currently you can get it in the secondary market through the Nairobi Securities Exchange. You just need a DAO CSP, which you can open from any bank or custodian or individually from the app. The second bond is 2021-018 to run through all the way to 2039 with an interest or coupon of 12.67%. and also a yield of 12.68%. Remember, the main or the key thing takeaway here is when you're looking at a bond, you're looking at buying at the highest yield or a bond with a high yield. That's the best way to look at it. And the last one, to run all the way to 2042, first issued in 2021 to run for 21 years with an interest or coupon of 12.7% and a yield of 13%. Very easy to access, like I said. Minimum investment if you're buying directly from CBK, it's 50,000 shillings, and also at the same time, you'll get what I would call consistent and predictable return. You can go to the next slide, Nelson. Okay. So, how do we now move? We've looked at the various asset classes. We've looked at the various components of these asset classes, features of these asset classes. So how do we now move from Paycheck to this wealth journey? Of course, you have to look at it from a point of whatever income that you receive, how you're going to direct it safely to an asset that will generate a return for you. The ultimate goal is to sit back and the money to work for you. And for this case is automate your savings, diversify, make sure that you manage your risk by diversifying. Like I said, the various funds have different risk profiles. So ensure that you've diversified to make sure that in case of anything, never have in investments, we say it's never guaranteed. That word guarantee is never in any investment. So you have to make sure that you diversify to ensure that you invest safely and you invest in funds that are monitored and regulated by the Capital Markets Authority. That is the number one thing to do. Don't invest because of return. Don't invest because someone has promised you 20%, 30%, 50% return. Invest because, number one, you understand the product, you understand how the product affects you, and also you are able to withstand the risks involved. Can go to the next slide, Nelson. Okay, so the goal, which is of course to be wealthy, the conversation to turn your paycheck to wealth. Of course, the stage, first of all, you have to have a foundation. And as an individual, of course, monthly liquidity, ensuring that you're able to take care of emergencies, you're able to allocate a specific part or percentage of your paycheck towards investments, fund, and the like. And then information. Look for information in terms of CMA regulated moved funds, asset classes that are safe, bonds, and the like. And then, of course, discuss how can you access these funds? What are the fees involved? Like, for instance, there's some funds that are global funds, offshore funds that provide very, very, very attractive returns, but the fees involved will take almost all the returns that you've received. So it's very important to understand the fee structure of these particular investments that you're looking to do. Then, of course, inflation. Currently, inflation are between 5-6%. So anything offering you better than that is shielding you from inflation. Anything offering you 5-6% is basically maintaining the money, the value of the money where it is. Anything offering you less, it means you're losing money. Of course, you plan your goals. You have your short-term goals, your medium-term and long-term goals. Of course, you have to match go long-term in terms of bonds if you're looking to uh, have a buffer of a reserve of funds for you for your retirement. You can put in your emergency funds in money market fund and the like, but just make sure that you understand the liquidity of whatever investment that you're doing or the market risk and the fees involved. When you're growing long-term wealth, of course, the very first thing is to ensure that you compound your returns. That's the only way you'll grow wealth. If you put money in a fixed deposit today, 1 million shillings, every month, let's say you earn 10,000 shillings, and you take that money and spend every month, take the 10,000 and spend, that 1 million will never grow. But if you reinvest the interest, you'll ultimately move from 1 million to 1 million, 10,000, 20,000, and at the end of it all, you'll have grown your money. Diversify to ensure that you take advantage of different seasons, and it's very prevalent. They are more or less indirectly correlated. You find that when equities are performing really well, yields on the bond side are low. And when the yields are rising, the equity market is not really performing very well. So diversify to take advantage of different seasons. Then, of course, retiring with choice. This comes with flexibility after you're working. You're working after your working age. So you have your investments, paying for your bills, paying for maybe your insurance covers, paying for uh, uh, could be still your children could still be in school. You could be having some investment projects. So the investment that you've done all across your working life would now pay off when you have nothing else to fall back to, unless or only your investments for your children, for children education and the like. Then, of course, you have to have that contribution discipline. Like I said, automate 10,000, 5,000 every single month. It will become a habit. It's like I said, it will give you a mental stability, knowing that every month I put aside. We can go to the next slide, Nelson. Yeah, so from here, I'll hand over to Nelson, but I see there are some queries coming through. One from
I think for the
Moniki.
questions, yeah, I think
Yeah,
for the questions, we can answer them after the session, once we are done, the presentation, after the presentation.
absolutely,
Oh,
Alfred. Thank you for
okay.
that. So, Nelson, you can take it up, and then we'll do the queries right after.
Thank you. Thank you so much, George, for that comprehensive insights on investments, wealth, and I'm sure the team have, got quite a bit to think about on how to, look into this. I'm sure, all, even most of us have already, gotten into this, in some form of way, in some form of investment. Maybe it's equities, maybe it's in the bonds and so on. So, with the insights given by George, we can be able to, continue building on that and seeing how best we can plan for our future. As earlier stated, my name is Nelson Kabau. I work for the Stanbic Bank Assurance team, or what you'd call the insurance arm of the bank. And it's a pleasure to be here just to, talk about, some of the issues here. We've talked quite a bit about, creating wealth. We've talked a bit about, saving and investing, and George has gotten quite a bit into that aspect of investment. Of course, we're living and enjoying, why work so hard? And if you're not enjoying a bit, if you're not traveling a bit, if you're not taking care of your family and traveling and so on. So, and obviously you're thinking about your shared legacy. But at the end of it all, what encompasses all that is how do you protect that you have built? How do you protect that you have spent so much time, so much effort, so many hours at work, in your business, and so on? How do you protect that? Because given life's uncertainties, some of these things can disappear at the click of a button. They can disappear, when you just bat an eyelid and things just go wrong, and you lose all that you have spent so much time to build. So thinking about it in terms of why is this important, right? So how do you plan wisely and protect yourself, your family, and your assets? And the importance of how do you protect yourself against unforeseen events that can erode your wealth, right? Right. So to achieve this, you need to have, a very sound financial plan and adequate insurance in place, right? And there's so many types of insurance out there. You've got under short-term insurance, you've got your motor insurance covers, you've got your domestic package, and this one, a lot of people, in fact, I can bet there are very few of us here who have got household content or domestic package insurance for our assets in our homes, our televisions, our fridges, and our laptops, and so on in the house, right? Property insurance, travel insurance, personal accident, and so forth and so on, right? Long-term insurance aspect where the long-term covers that we have, life insurance, health insurance, any endowment plans or savings plans, funeral policies, and education plans. In this country, we say education is very emotive, right? Kenyans, actually in the whole of Africa, we are the top in terms of how we look at education, and the statistics to back this, and how we take, education for our children, very important. So education plans are actually the biggest seller, insurance or life insurance seller in this market. And it just says how critical we are, or how important education for our children is, and taking up, education plans. So there's so many different types of insurance plans available out there, right? So you don't need all of them. It's based on your risk profile. George has gotten a bit into what is your risk profile? How do you look at risk, basically? So based on your risk profile, you don't need all of them. You just say, these are the main insurance covers that I need to take. And so, and to plan for my future. But obviously, having no insurance is not a very, very wise move. So something critical to always think about. So basically what we're talking about here is leaving a lasting legacy for your loved ones, right? Because there are areas to look at, like guaranteed benefits for some of the covers that are there, tax benefits, right? A lot of our covers, especially insurance covers, have got very good long-term tax benefits once you take up insurance covers. And then ultimately, it's a peace of mind that we have, right? The peace of mind that we are secure, our families are secure, our loved ones are secure, and our assets that we have spent so much time building are secure. So there are very many, aspects, but I'll get into three main ones. The three main ones are investment linked protection, right? And there are guaranteed benefits to this. So basically, it's an investment product, but with an insurance flavor, right? Investment product, but with insurance flavor, where it gives guaranteed benefits on death, permanent and total disability, critical illness, right? We know accidents do happen, and it's not always about death. People say if an accident happens, you die. No, there are accidents that happen where now injuries, serious injuries occur, and somebody is unfortunate to be permanently and totally disabled. So what do you have in place in case of that uncertainty? Critical illnesses these days, Kenyans, we've been eating a lot of chips and, very many fried foods. And every weekend we are taking our children out to eat, some of these junk foods and so on. And unfortunately, over time, some of these things build up to very, very serious critical illnesses. We've seen before, we used to think critical illnesses are for people in their 60s and above, but we actually seen critical illnesses coming up for people in their 30s, early 30s, going into their 40s, very, very early in life with very serious critical illnesses. So these things do happen. How do we plan? So there are various plans out there in terms of investment-linked protection where you can use it for school fees planning. So basically, it means that it's a fund that is there that in case something was to happen to you, in case there's a disability, a serious disability, there's a critical illness, that the dream of a good education for your child does not end there. The dream of taking your child to the best schools available, whether here in Kenya or even abroad, does not end with an unfortunate event. So that's why, some of the school fees planning, as I mentioned earlier, education is very emotive for Kenyans. And so school fees planning is very critical for us as Kenyans, and one of the biggest. But not just that, it's also looking at any future big plans that you may have, a future big construction project that you want to get into, a future big vacation and to take your family. Just because something unfortunate happens to you doesn't mean that that dream should die, right? Doesn't mean that that dream of taking a dream vacation should die for your family. Doesn't mean that that big project that you're thinking about, buying a big piece of land to build a home, or buying or building a big house, does not die because something unfortunate has happened to you. So that's how we think about some of this. So we combine the investment aspect of it plus the protection aspect, and so the investment linked protection products. Medical is also very critical. Actually, statistics are medical has overtaken even motor insurance in terms of the premiums that have been paid by Kenyans for medical, because Kenyans have realized that, what, medical bills are very high these days. If you walk into a hospital, once you get a bill, you wonder where you're going to even start, basically. And there are covers which can protect that. And so we've seen quite a number of Kenyans actually taking up medical insurance and not just even relying. So for us as employees, or those who are employed, there's probably your employer has taken up a medical plan for the staff members, but you can boost that medical plan, because some of the covers will probably give very low inpatient or outpatient limits, but you can boost that by having a medical plan for yourself and for your family that you take up on your own, just to boost whatever you have. Or if you're in business and you need an medical insurance, then those plans are available. So they cater for emergency medical bills for immediate family, but also planning for our parents, basically, right? We know after a certain age, our insurance covers will end. They'll say this cover will end once you retire. And so our parents who took up these covers, maybe when they were employed a few years ago, those covers have ended. So what happens to them? And it's you who's there. There are, very good medical plans that cater for parents between the ages of 60 and 80 years, which can be taken up and give you peace of mind that your own parents, yes, you're covered for you and your family, but your parents are also covered because we know some of these medical bills. We know people who've had to sell their assets, they've had to sell their land, they've had to sell their houses just to take your medical bills, and you don't want to get into that sort of situation. So there's full access to top-tier medical institutions here in Kenya and even abroad, which provide the best medical care. I always say it's never too early to think about retirement. So even when I was younger, in my early 20s, it never occurred to me that I would ever get to 60 years and to retirement. I was just enjoying my life. I just gotten a job, and the comforts of having a new job and getting some money in your pocket and being able to do things, go out with your friends and do all these other things, start a young family. But the years do go by very, very fast, I promise you. So for those of us in our 20s thinking you'll never get to 40 or to 50, I also thought the same, but I'm already in my 40s currently. And you wonder how these years went by so fast. So it's never too early to think about retirement. I know George has already touched onto it, and some of the areas you can think about retirement. Don't just rely on the retirement package from your employer for those who are employed. Don't just rely on that. Look at other ways you can show up or you can boost those pension savings, because what we call the replacement ratio, right? We always say that you need to have an income on retirement of about 70% of your last paycheck before you retired. So if you calculate your pension going forward, and for those of us who are probably closer to retirement, are you going to get a pension which is giving you at least 70% of your last paycheck before you retired, right? That's a replacement ratio, and that's something to seriously think about, because and I've come across a lot of people who've retired and they struggle. They struggle because they thought at retirement there are no bills, but the bills are still there. You still have to pay bills. You still have to move around. You still have to do, go around and do other things. Where are you getting the liquidity or the money or the cash for that? So it's never too early. And there are individual pension plans which can cover that. There are annuity plans which pay the monthly pension or quarterly pension after retirement, and also drawdown funds which also offer monthly payments, quarterly payments, semi-annual or even annual payments after retirement, which can keep you, comfortable in your retirement years, so that you continue enjoying a life even after retirement, and not just being sad and depressed because you did not properly plan for retirement. So those are the three ones I wanted us to to think about quite a bit. So in here, I'll just go into one of the areas where one of the covers that has really picked up in this country, and I've already mentioned long-term investment with built-in life, critical illness, and disability protection. So it's about growing wealth while protecting what matters most. So you can invest a lump sum, a single premium, for a minimum of only 50,000 shillings for a 5 to 20-year term, and invested in conservative funds. So obviously it fits anyone between 80 and even 80 years old. So somebody has retired, but they've got a good fund or a good balance somewhere, they can still invest in this, which provides the aspect of built-in life, critical illness, and disability protection. You can also top up every month or every so often for as little as 1,000 shillings per month, and withdraw up to 25% from the second policy year of the policy. You can withdraw, and the balance will remain invested basically. We have made it easy for you to monitor the performance of that fund, and so You can always get in and see where am I, how is the fund growing. I'm not happy about the returns. You call us and we can explain and see how we can build up your funds within that. So in terms of building a legacy, because we keep on saying, in this day and age, you don't have the shambas to give our children in the future, right? Those days are gone, right? We don't have maybe the big businesses to leave our children. So what are we going to leave our children in case something happens to us, in case we're not there anymore? So it's about building that legacy. And so looking at it from that aspect of life cover will equal 10% of accumulated fund value. So if your fund is at 50 million, for example, then 10% of that is your life cover. You can imagine that. So in case something happens, you get the full fund value plus an extra 5 million Kenya shillings, for example, in case you had a fund of 50 million. In case of critical illness, you pay 30% of the life cover that is there in case of critical illness and PTD. And we know those funds are very critical. If it's a critical illness, you can use those funds to go to hospital. We know some of the bills do escalate in case of critical illness. In cases of disability, bills do escalate. And having that sort of fund being paid to you in case of a critical illness or disability is very crucial, to continue living, a life worth living. So at maturity, obviously, 100% of the accumulated fund value is paid out at that point. So the product is about investing with confidence, is about accessing the flexibility. Not a lot of life insurance covers out there are flexible, right? This shows the flexibility. You can have some withdrawal. You can inject funds at any point that you want for as low as 1,000 shillings per month, and continue building up that fund. And of course, the aspect of protecting with purpose. You don't want something happening to you and, auctioneers are sent to your house, or we're told to pick a car, the car which is there, which the family has. And so it's about protecting with purpose, protecting the assets that you have, and obviously protecting your assets and the life that you have, basically. And so I've already gone into this in terms of the protection of the wealth journey from investment to legacy. So something to really think about instead of how do you start for as low as 50,000? How do you grow for as low as 1,000 per month? How do you protect? By keeping the cover active, you can access, there's death benefits, critical illness benefit, disability benefits at any time. How do you access? You can withdraw or even remain invested. If you withdraw, you can withdraw up to 25% annually, and obviously 100% at maturity of the fund. So this product is an investment-linked insurance product. It's not a bank deposit, right? If it's a deposit in a bank, in case something happens to you, you get exactly what is in the bank deposit. But for this cover, you get what is accumulated in the fund together with any other benefits as may be from a death, critical illness, and PTD perspective. So I think that's it from our side. I know we've left a few minutes, about 7 or so minutes, for any questions, any Q&A. Feel free to raise any questions. And if we are out of time, feel free to raise it with Alfred, and I'm sure he'll get in touch with us. We'll get in touch with Elsie, and we should be able to respond as quickly as possible to any questions. Thank you for the time, and back to you, Alfred.
Yes, thank you for the clear presentation, and I'd like just to go straight to the questions because of time. One is a very good presentation. Speaking of matching my goals with the horizon and maintaining liquidity, black tax maneno, how can someone build personal wealth while also supporting parents, siblings, children, or other family members? How do you set boundaries without neglecting genuine family responsibilities? As a Gen Z, it's quite a thin line between maintaining family relations and growing your own wealth. So you can answer that first, either George or Nelson.
Yes, thank you, Alfred. I think I can answer that, and it's a quite an important question, more so in our cultural setting, where the moment you start working and everyone knows that you are working, you already feel obligated to assist or to help them. And more so when it is kin, it's even more important to set structures. So I think it requires you have to transform the unstructured way that majority of people do it. Like every time you get a call, you send 100, you send 200, you send 1,000. I think the best way would be to transform that to a budgetary, to an item in your budget. And by that, I mean that you be quite predictable in terms of how much you are able to offer in terms of black tax, as they call it, to be able to to be able to have what I would call boundaries and uh, and ensure that you don't get those unexpected demands. So it's a very thin line because, of course, you have to develop first a thick skin. You also have to develop a strict budget, knowing that if this month I've budgeted to give 10,000 away as black tax, then that's the cap that is my support cap. And you have to treat it as an expense. Don't treat it as assistance, because if you treat it as an expense, at the back of your mind you'll have it strictly knowing that every month this is how much I spend in terms of black tax. And the other thing is to not wait for them to ask. If you see the moment you just sit and then you get a call, you get a text, I think by automating, you'll say every month on the 10th or the 15th or the 20th, I'll be sending this amount. Then at that time, when they come back in terms of this is what we need, you'll have set down your role. This is how much I can afford, and this is how much I have, and it's an expense to you every month. The other thing, of course, is to maintain an emergency buffer, like I said, and I think also this ties up to the second, the third question. Of course, the emergency buffer is essentially to shield you from a rainy day. But we live in a society, the societal fabric is to help one another, lift one another. So of course, the emergency fund will come in handy when maybe there are things or obligations that it may be for your kin or for your family that needs to be sorted. But the key thing is to automate, have it as a line in your budget. If you have it as a line and treat it as an expense, then you'll go a long way in terms of managing the expectations. How you distinguish between, how you set boundaries, like I've said, of course, it's quite a thin line, like the question has really highlighted. But if you treat it as an expense, then you still have a line in your budget for investment. Have that as consistent as possible. Growing wealth is not a 1 day, 2 day, 10-year affair. It could even be a 20-year affair. But consistency beats everything. $1 compounded over 30 days is much higher than 1,000,000 shillings now. So just make sure that you consistently put aside your investment and consistently put the obligations of the black tax as an expense, and be very strict about it. Flexibility now will come with the emergency fund. I hope a bit clear.
Yes, thank you, George, for making it clear. And it's clear that consistency and ensuring that the compounding effect takes effect on your income, so I'm able to assist where possible. The other question is, on side hustles. There is a lot of advice telling Kenyans to start a side hustle, but what if the side hustle simply creates another job rather than an asset? How can someone distinguish between additional income and actual wealth building activity? Lastly, can an investment in the mentioned asset classes, yield, bond, equity market, be presented as a side hustle, considered as a side hustle?
Thank you, Alfred. And this is a very good question in that when you talk of a side hustle, people will sometimes think that you're somewhere doing your job, and then there's some business that is running, earning you income even when you're not there. But that is very wrong, because assuming you're putting up a business, you are investing something in that business. You're investing your time, you're investing your resources, expecting to get a certain return. If time is very important, maybe you have your day job, which requires you to be very hands-on, then you will have to get someone either to run your side hustle. That will come with costs. It will come with its own risks. As you know, employees are number one risk in a business. And also, it will also come with additional duties in terms of in the evening, maybe you have to go audit your books, you have to pass by your business to see how it's going. So it's when you looking for a side hustle, and more so, yes, we are allowed to explore either our passions, either activities that generate income, but ensure that whatever you invest, be it time, be it resources, is correlated with what you get as a return in terms of income from that business. You can distinguish between additional income and actual wealth building activity by evaluating the kind of income that you receive from that side hustle vis-a-vis the kind of investment in time and resources that you've put in. If it's a business that requires you to maybe go and stay overnight, and then the following day you're not fresh for your day job, really, that tells you there's something wrong. If it's a business that requires you every day to make sure that you go through the books to ensure that no one has stolen a shilling from you, then it's not really worth it, because you'll have now to invest in other things, such as maybe systems, to ensure that everything is okay. So it's important to have a side hustle, and for this case, an investment could be a very good side hustle. Why? Because it's a passive income. You don't have to be there for it to run. If you put in your 100,000 in a bond, you don't have to be there for it to give you the coupon. The coupon will be automatically be credited to your bank account. Whether you know it or not, you just see money in your bank account. If you continue building your investment, they continually now start working for you passively. You'll be doing your day job. Your money will just be flowing without you necessarily being there.
Okay, thank you for that. Lastly, to the last question before we welcome closing remarks from our general manager Wanjiko Manyara. The last question is: I hope this won't be a repetitive to what you had presented, but if you had to design a wealth building plan for a 30-year-old Kenyan professional earning 60,000 today, but with the realistic possibility of losing that income once the contract ends, what will you prioritize in the first 6 months, 1, 3, and 5 years?
Thank you, Alfred. And I'll also go back to the objective. For a 30-year-old Kenyan professional earning 60,000 a day, 60,000 maybe a month, and they're looking to have goals for 6 months, 1 year, 3 years, and 5 years. The very first thing you have to put up is an emergency fund, even before you think of sophisticated investments. The very first thing is to build an emergency fund. Once you build an emergency fund, then you can now look at more medium-term to long-term goals. Because an emergency fund will take care of your of your bills if anything goes wrong or if there's a rainy day. And once you have the emergency fund, now you'll have the foundation now to move from now the emergency fund, you build a money market fund. From a money market fund, you go buy a share or you invest in a bond. It's very important to look at it from a perspective of sustainability. You don't want to get the 60,000, put it all in shares or in bonds, and then next month maybe you don't have that contract, and then you have to pay something like really urgently, like a bill, and then you have to go back, get the bond, try to sell it for you to pay that bill. Sustainability is measure your objective and where you are in terms of income with what you'd want to achieve. So if you want to achieve first the foundation, which is the stability, you start from an emergency fund. From the emergency fund now, you can move to an investment such as the money market fund or a bond. Ultimately, the goal is to ensure that first you're comfortable. The risk, you take care of risks, which could include the contract not being renewed. That is a real risk. So if the contract is not renewed, that means the 60,000 income will not be there. So take care of the risk first, put aside an emergency fund that could maybe give you or give you a further 3. If you have a 6 months emergency fund, it could give you a flexibility in terms of once the contract is over, you'll have 1 or 2 or 3 months to look for another job or start an activity that will earn you money. So even before going long term, try and set the foundation right. It will set you on the road now to wealth.
Thank you so much, George, for the remarks in regarding to 1, managing the risk, 2, consistency, and 3 also being just considerate of what you can be able to invest in. And with that, we'd like to welcome our General Manager, Wanjiko Manyara, who is on the call to give us the closing remarks as we come to the end of the session.
Thank you, Mungai, and thank you, team from Stanbic. Could we really just clap for them? Very, very insightful presentation. As you are aware, or at least for those who are on call here, this is a beautiful presentation. This kind of forums are really our business as the Professional Industry Association Secretariat. We do this to ensure that we live up to our mission, which is to be a leading forum for expertise and excellence in the oil industry. And we assure that it will advance the anticipated professionalism and free enterprise, while we uphold the highest standards of integrity, business ethics, and deep commitment to environmental, social, and governance ideals, including safety, health, and sustainability. It is worthwhile to note that this kind of presentation promotes people-centered organizations, because at the end of the day, it is people's wellness and mental comfort and physical comfort as well that enables companies to reap on a bottom line that is uninterrupted. If we are paying our teams and we are not able to guide them on how to use their hard-earned sweat for themselves now and into the future, I don't think we'll be doing any justice. So it's so important to have our members who are endowed with this kind of expertise to agree to host or to allow us to use their expertise for the benefit of the larger PIA membership. So I think we all have picked a lot, and being that we have become very concerned as a community, as a nation, on the mental wellness of our people. I think this is an area that can help us mitigate stress. When we mitigate stress, it means that we mitigate against this stress compounding into mental illnesses that then cause us to do desperate things, including increase in loans which we are unable to honor, and so on and so forth. So this just enables us to pre-plan and to work with entities that are able to walk us through wealth management. And we just want to thank Stanbic Bank. Please look out for our next lined up activities, including the upcoming webinars and also the upcoming energy stations forum and lots of training that's also lined up. I'm sure Mungai, you will share the presentation and also the recording. But for now, we want to thank all of you who showed up and accolades to our partners, Stanbic Bank. Enjoy the rest of your afternoon and continue to stay in touch with us at the Secretariat, including other areas that you may want us to provide discourse on going forward. Asanteni sana.
Thank you. Thank you so much.
Thank you so much.